A comparative financial analysis of two firms, Macy's vs. Nordstrom's, by Jessica Castanis and Christy Marina. Who are our shareholders? Macy's has 395 million outstanding shares, and its shareholders own 87.54% of the firm. Nordstrom's has 200 million outstanding shares, and its shareholders own about 61.27% of the firm. Both firms have similar top investors, and they own 27.5% for Macy's and 25.8% for Nordstrom's. Both companies share some of their top investors. Out of the top 5 institutions, 3 are the same, and Vanguard is number 1 for both companies. Why do investors care about capital structure? To an investor, capital structure is very important because it can have an effect on the level of return they can receive. Investors want to know that the company has stability and a fair mix of debt and equity in order to maximize their profit. Some advantages of debt are cost reduction, profit retention, financial leverage, and tax savings. Some disadvantages of debt are financial stress, financing costs, cash flow shortage, and limited liability. Some advantages of equity are no repayment obligation, low risk, easy access, and networking. Some disadvantages of equity are less control and increased costs. A company's debt ratio is determined by dividing their debt by their assets. This is used to determine the amount of leverage a company has. A low ratio means the company is less dependent on the money borrowed from others, and they have a strong equity position. A higher debt ratio means the company has taken on more risk. Based on an analysis, Nordstrom's is the most favorable company based on their capital structure. They are operating at levels extremely close to their optimal, which indicates they are successfully maximizing their capital structure. What is our cost of debt financing? Pre-tax debt for Macy's was calculated by adding the S&P 500 credit rating and the 10-year Treasury bond rate, which gives Macy's a pre-tax cost of debt of 4.5%. Pre-tax debt for Nordstrom's was calculated by adding the S&P 500 credit rating and the 10-year Treasury bond rate, which gives Nordstrom's a pre-tax cost of 3.65%. After-tax cost of debt is calculated by using the pre-tax cost of debt and multiplying it by 1 minus the effective tax rate for that firm. Macy's after-tax cost of debt was 2.87% and Macy's was 2.24%. What is our cost of equity financing? First, we calculated capital asset pricing model using 2% as the risk-free rate and 5.5% as expected risk premium. We calculated our beta by using an average of all the different betas we found from other resources. For Macy's, CAPM was 9.98% and Nordstrom's was 10.20%. We then used the regression tool on Excel with the historical prices from Yahoo Finance. From this data and graphs, we were able to compare the betas from our sources and what we found in our regression 5-year monthly. What is our overall cost of capital? Using the financials from third quarter 2012, we were able to compute the debt and equity ratios. With these figures and also pre-tax cost of debt and cost of equity from previous slides, we are able to calculate the WACC, weighted average cost of equity, debt, and preferred stock. Macy's ends up with 7.17% and Nordstrom's 7.79%. Could we lower the cost of capital by changing our capital structure? According to the capital structure analysis for Macy's and Nordstrom's, we can see that both companies are just under their optimal levels. If either company was to increase their debt to the suggested optimal level, it would increase the firm value and potentially generate more earnings. However, in return, the increase could have more disadvantages overall, such as a risk for bankruptcy or lower bond ratings. Would more debt create unnecessary risk? There are some risks involved with carrying more debt than is necessary. Debt carrying capacity for companies depends on the industry and market in which a particular company is operating. Since retail is considered a risky business already, equity investors steer clear, and as a result, retailers often have a higher debt which they must manage very carefully. Based on our analysis of Macy's and Nordstrom's capital structure, it is clear that adding more debt to either company would create an unnecessary additional risk. How would a financial restructure affect the value of the companies? A financial restructure could negatively affect both Macy's and Nordstrom's due to their level of debt ratios. Macy's change between debt and optimal is 5.18%, and Nordstrom's is 2.47%. With the optimal debt ratio with 10% intervals, both companies are working close to their optimal levels, and any increase with debt would have an adverse effect on their performance. As a result, the value of their companies would negatively be affected, and their bond portfolios could also decrease. What do other companies do? We compared Macy's and Nordstrom's with Dillard's and JCPenney's. Macy's, Dillard's, and JCPenney's have similar weighted average cash, other current assets, and long-term assets. Nordstrom's long-term assets are about 15% less than the other companies, but they also have more weighted cash on hand compared to the others. Shareholders' equity of Dillard's is almost double the other companies. For current liabilities and long-term liabilities, Macy's, Nordstrom's, and JCPenney's are all weighted within 5% of each other. Macy's and Nordstrom's market caps are at least double of JCPenney's and Dillard's. Even though their market caps are quite different, the weighted averages show that the company's financials are comparable. Valuation. Are Macy's and Nordstrom's stock fairly priced? Stock valuations are used in order to determine whether or not a company's stock price is fairly valued. Three common valuation methods are discounted cash flow, price-earnings ratio, and comparative multiples analysis. First, we use discounted cash flows. This is to estimate the appeal of an investment opportunity. One disadvantage of using the discounted cash flows is that it uses future cash flows, which are difficult to predict for any company and ultimately affects the accuracy of the method. With this method, we were able to conclude that Macy's was slightly overpriced and Nordstrom's was overpriced. Secondly, we use price-to-earnings ratio valuation. We calculated this by dividing the price per share by the earnings per share. This will tell us what the market is willing to pay for the company's stock. Macy's ratio was 12.35 and Nordstrom's was 16.83. The Pierce ratio was 14.35, which means that Macy's was underpriced and Nordstrom's was overpriced. And lastly, we use comparative multiple analysis. It estimates the value of an asset by comparing it to the values of the comparable assets assessed by the market. This analysis shows that Macy's was underpriced with current price of $39.02 and potential price of $43.31. Nordstrom's was overpriced with a current price of $53.50 and potential price of $49.75. From these three methods, we can determine that Macy's is just slightly underpriced and Nordstrom's is overpriced. Thank you for your time.